Thank you so much. It's so great to be here and to have amazing capabilities here on the stage with me. I suppose just as a summary of our global strategies, unfortunately, of course, Robico is not here. But a question that I often get in the market is why do we have so many equity funds, global equity funds? And it's because of the client demand. On the Robico side, we've got core holdings. So if you think Robico's strategy, if you want a diversified exposure to global markets, whether it be developed markets or emerging markets, you want a low cost access to that. You want a passive alternative strategy. Robico is the strategy for you. But if you're wanting to really take advantage of style sleeves within portfolios, you want to either combine value, growth, and quality, you want to use it just as those three, or you want to do it as the core component of Robico with the satellite positions of active managers. These are the guys for you. So I've got four panelists from Evelo, Lyrical, and of course Evelo, Lyrical, and Jennison. So firstly, you've heard a lot about the strategies, or you got a bit of an insight into these strategies. So I thought let's first give an insight into what makes you guys different. So there's amazing global managers, obviously, are already available in South Africa. Global has become quite a talking point these days. Why? For a few reasons. Regulation 28 has obviously increased the access to or allowed you to take more money offshore. Another reason you guys know is that there's a little or less opportunities in the South African market from a listed perspective. Hence why even our local funds have access to global strategies too. But also clients are becoming global citizens. You know that. We've got clients, we've got a client here who lives in South Africa and also lives overseas. So clients are becoming global citizens. So you must make sure that you have strong global capabilities to meet on those needs. So now you guys, you're very differentiated in your investment approach. We've selected you guys for your unique skill set, being growth, quality, and value. And as I said, we've got amazing managers already here. But why should our valued clients choose you guys over what they're already using within their global portfolios? Let's go
down the line here.
Yeah.
So I think of our differentiation points really around two things. One is the research and the research team. I mentioned that our analysts are very, very tenured. They come to us when we need to hire more analysts. They come to us mid-career with a lot of inherent experience, and then they typically stay with us. But we have analysts who have followed companies, their industries for 20 plus years in some cases, in many instances back to companies' IPOs. And it just provides a tremendous context in which to analyze the day-to-day, quarter-to-quarter, year-to-year attributes of a business model, products, and services. So research is one differentiation point. And the other differentiation point is that sell discipline I mentioned. And it's important to realize that, yes, there's the competitive dynamics that are changing, and we would take into account the need to trim or sell product maturity. But the other point of differentiation, which I didn't mention, is one around valuation. While it's important to understand the valuation on the inbound, we will never sell a stock purely based on valuation and a perception of valuation. We may trim a stock and reduce a position, try to lock in some of the gain, de-risk it a bit, but you never know, especially in a dynamic growth stock environment, you never know when the next revenue stream, the next new product capability, the next new market that this firm may enter may emerge. And so we want to extend that. It goes to that duration of growth issue I talked about. We want to make sure that we let our winners run and that we maximize the opportunity set as the managers of the business run that business. So valuation is important. We will use it to trim once we own something, but we will not sell based purely on the valuation to zero. I'll bring it back to our uncommon combination of value and growth. If you look at Lyrical versus other value managers, on the value side, I think over the last decade, what we've seen is a lot of, quote, value managers have started to own things like big tech, and you see the PE multiples creep up. And that's not something that we do. We do trade for 10 times earnings, so we are very clear that we will give you that value exposure that I think you very much want today. Now, relative to more traditional value managers that trade for those low PE multiples, we've got more earnings growth, we've got more quality, And I'll give you some examples of why, when you think about our quality focus, there are a number of industries that we don't invest in as a rule that you will find proliferating across our competitive set. For example, airlines, pure commodity businesses, they're capital intensive and it's very difficult for those companies to sustain goods ROICs. So we skip them. Because of our focus on analyzability, there are a number of industries we won't invest in. First of all, anything that is a clear disruption threat. I mean, you find that all over the cheapest quintile, traditional media businesses, brick and mortar retail. We don't invest in those companies. One thing that's a huge differentiator for us versus global value peers, we don't own banks. You will see them across most of our value peers, not just one bank, but many of them. And we think ultimately, the CFO of Citigroup might not actually know what the assets on his balance sheet are. And more importantly, there's a huge interest rate bet to getting a bank investment right. And we're not macro guys, so we would rather own Ameriprise, a business that double-digit earnings growth and is much, much more simple than a large bank. So that's the way I think about it. It is an unusual combination of that value and grow.
Awesome. Yeah.
Well, I agree with both of those things. Research and valuation discipline is definitely important for us at Evenload as well. I would say what's different about Evenload and my previous career was in academia. Evenload is not a tenure culture. It's a very collaborative and team-based approach. The company is very small. We are all owners in the business. We are all incentivized to work hard from day one and take responsibility. But
Yeah, I mean, the other thing we really, even though everything we do is aligned to long-term needs for our investors. So our ownership structure with the employee ownership is designed for us to be there for a long, long time and not forced out by anyone else. So what we do, what we said. And our valuation methodology is a very long-term quotas method, focused on how long businesses would deserve their returns with less capital is the future. What that's designed to deliver is a really stable set of returns for our investors over a long period of time. Really, everything about business is set up with that in mind.
Awesome. Thank you. I think what's interesting is that whilst these are very differentiated investment styles, there's one or two commonalities that I've picked up throughout. Number one is how long you guys hold stocks. All three of you, you don't trade your portfolios. Another area is the fact that you're really aligned with your clients. Can you just explain your alignments in terms of your various portfolios or your businesses? How you invest alongside your clients?
I think what you're getting at is our own stake in our businesses and our portfolios, in our return streams. The team at Jennison invests in our mutual funds in the U.S. very heavily. It's the biggest sources of our financial liquid net worth. We're not a partnership. Our ultimate parent is Prudential Insurance Company, Prudential Financial of the U.S. But the way around not having a truly owned firm is to instead invest alongside our clients very heavily in our funds. And just a separate comment here, the U.S. SEC makes it very difficult for portfolio managers to actually own individual stocks, just given rules around holding periods, trading, and the like. So from our perspective, the best way to own stocks that we would like to own is to own our own funds, because our funds own what we would otherwise own ourselves. That's how we think about that topic. The easiest way to answer that is that the 3 PMs at Lyrical, the vast majority of our net worth is invested alongside you, potentially, in our funds. The only thing we own outside of Lyrical funds would be some real estate. So we don't have a great hedge against value. That's where we place our bet. Yeah, I mean, exactly the same at Evenload. We encourage all of our employees to co-invest, but yeah, the portfolio managers have to control their savings in their own funds. So yeah, we share in the good size and the bad time.
Awesome. Let's talk about stock picks. Christina, I know Chris already alluded to those 6 characteristics when you're picking a stock, on the qualitative side and the quantitative side. Could you just give some examples or 1 or 2 examples of a particular stock that would go through that investment screen?
sure. So we like companies with strong competitive advantages. But what we like even more is companies with widening competitive advantages. And one example that we initiated a position in recently is Lint. the Swiss chocolate manufacturer. So Lind has been growing organically revenues at 8% historically for the last 10 years. And we think they have a good runway for growth to do that for another 10 years. So in developing markets, chocolate consumption is not as high as in developed markets. And there's a correlation between GDP growth and increasing chocolate consumption. At Nest and Lind is very well invested to take advantage of that. So they're one of the very few consumer goods companies that during the pandemic, they didn't cut back on advertisement and promotion. They stayed very well invested. So stayed top of customers' mind. Their margin currently is something like 15%, and they're growing that at a very steady rate. So it's sort of 20 to 40 base points per year. And, they sell those Easter chocolate bunnies. It's a lot of air in those. There's not a lot of chocolate. Like, they make margin, but they're choosing to invest that in advertisement and promotion to gain a share in all of the white space that they have in emerging markets. Another example that we initiated a position a couple of years ago is Hermes. So they make the Birkin bags, the luxury French conglomerate. And again, it's a very strong, intangible asset, very rich heritage behind the brand. It's very hard to reproduce that. And for a brand like that, the tricky thing is not to get greedy because there's a temptation to try and sell as much stuff as possible to as many people as possible. And from our analysis, compared to their competitors, Hermes has not been increasing their distribution. They haven't been widening their distribution, but instead they're going deeper. So they're deepening their relationship with existing customers and building on the loyalty they have with existing customers.
Awesome. Thanks, Christina. What's interesting for me with these three portfolios is fundamentally what you'll understand is that the crossover of stocks is minimal. So across all these three portfolios, I looked yesterday, I think there's only 8 stocks, obviously not across all three. That it's interesting that if you're wanting to have a globally diversified portfolio, you really aren't going to have that if you had to combine these 3 stocks. Hermes is actually just one of them that Jennison also holds. Now, John, I'm going to direct this one at you. I love that story you told me on Broadcom. So I think it really explains the way that you guys think of value, that unique process of buying cheap, but looking at return on invested capital. So could you just, I think, share with the audience that story?
Yeah, sure. So Broadcom, you probably have heard of it now. It is a darling, and for good reason. It's a major AI play, and we don't own it anymore. But it was one of the best investments that we made at Lyrical. I'll give you a sense for how we operate. Now, we bought this stock in 2013, and at the time it was a specialized maker of semiconductor chips. And it had a history of growing its earnings at a double-digit rate. And over the decade or decade plus that we owned it, grew its earnings at a 30% plus rate, even though we bought it at about 13 times earnings. Now, luckily, over the 10 years that we held it, it never really traded above 15, 16 times earnings. It never hit our estimate of intrinsic value. And so we held that stock the whole way. Now, the narrative is interesting because you can see how if you really have that long-term investment horizon, our average hold period is 7 to 8 years. You can watch how if you buy quality business really cheaply over time, their narrative will shift. And so in the case of Broadcom, it went when we bought it to basically what people thought of was a fraud. Here was a company, you might have heard of a company called Valiance. What they were doing was they were buying drug companies and they were killing the R&D departments and juicing their earnings. And it was not a good thing to do because you kill your future growth if you kill all of the R&D. And people looked at Broadcom where these earnings were going up 30% a year, and they were doing a similar thing. They were buying chip companies and slashing R&D spend. And our research there was to say, hold on, let's go in and really see if this is true or not. And what we found actually was quite different, which is what Valiant was doing. Oh, sorry. What Broadcom was doing is they were going and buying these chip companies because they had a core chip that had a 70% type market share that was dominant. They really liked that one chip, but they realized these smaller chip companies, they were investing money to try and grow with lower returns in areas where they didn't have expertise, or they didn't have the competitive advantage. So they would cut the R&D department, but they would cut from non-core chips and actually invest more in the chips that mattered. And so actually the competitive advantage of the chips they were buying was growing over time. And so we thought that indeed this was actually a very sustainable business. Now, fast forward to today, we sold the stock earlier in the year as it crossed about a 20 times PE multiple. And of course, we sold it too early. But that's our approach. And our sell discipline is to say, look, we have a job. It's let's go buy stops in the bargain bin. Most of them are bad, but every once in a while, there's a Broadcom. Let's do work on that and let's be patient. And when that stock reaches a market type multiple, we'll sell it. A growth guy can buy it and might have a great experience with that, but that's not really my job. My job is to say, I don't really know what the AI growth is going to be for Broadcom, but I can find something else in the cheap market, in the cheap part of the market, and kind of rinse and repeat.
Awesome. Well, I think it's great segue into sell discipline. You heard earlier Tom talking about one of their differentiators is their sell discipline. So I see we ran out of time. And I'm going to throw this one quickly at you. You alluded to earlier your disciplined approach of selling out of China. Give me another example of that sell discipline. Because obviously sell discipline and growth styles, I think is exceptionally
Sure.
important.
So Tesla, I mentioned, was one of our 4 stocks that actually hit our 10% cap. That did so back in late 21. And we sold the last share at the very beginning of this year. And in that intervening period, we took it from 10% pretty steadily downward to that final sale. And the reasons for that was after many years of being pretty much the only game in town for EVs, you actually started to see some viable, decent, competitive product out there from other manufacturers in the hybrid space and in the BEV space as well. And Tesla's response to that was to begin cutting prices because they had the room, the capacity. But that means that our analysts had to go back and recast the financial model, make assumptions around lower margins going forward. And obviously that has an impact on valuation. So the first series of cuts came as the competition started to emerge, as the models had to be reassessed and redrafted. Then you will recall that along the way, Elon picked up or purchased Twitter on his own. He financed a portion of that purchase with his shares of Tesla. So then we went through a period of a steady drip of sale pressure on the stock as he kept pushing more of the stock out the door to meet his financial obligation in the purchase. Along the way, he also, for whatever reason, seemed to increasingly make a bit of a shift to the right from a political point of view. And you can see today he's gone quite extreme, which is a little ironic because most people who are interested in electric vehicles are probably not that direction. They're probably that direction. He's also made some rather disparaging remarks about women, and more women than men typically buy Teslas. So this combination of all these factors emerging along the way had led us to just continue cutting, and eventually exiting that position the last few shares being of this year. Now, I will admit to you, the stock has actually moved higher since then. We won't know whether that decision ultimately was the correct one or not. But obviously the process, the rationale was sound. And we know from our analysis and our data that over years 3 and 5, post a final sale, we typically outperform both the benchmark, or put it a different way, those stocks that we sell underperform the benchmark and underperform our portfolio as well. So only about a quarter of the time do we actually end up being wrong to have sold. So will Tesla fall into the right decision or not? Time will tell. But we do keep track of that as well in our process so we can understand those dynamics going forward. But that's an example of something that we made a tremendous return. Actually, it's our second best returning stock over the trailing 5-year period, but it's no longer owned because of the shift in fundamentals, shift in leadership perspective and some of the actions of the CEO, and it's no longer in the portfolio.
Awesome. Thank you. Thank you, guys. I see over time. I'm literally going to ask one question. It's just the Even Notes team. Quality is, and it's one of the questions that have come up here, is quality is one of those enduring styles that obviously provides the stability in the portfolios. But how do you offset or provide stability and as well as deliver alpha for clients? How do you get those right?
Yes.
So you can be quick.
Yeah, it's very quick. So it comes back to the sort of twin disciplines of our risk management framework and our valuation approach. We really want to deliver that sort of smooth ride for investors over time because we know that the clients of our clients have to talk to somebody and justify exactly what's going on. So when the markets are up, they want to be able to say, this is how the portfolio behaving. This is why the portfolio is behaving this way. We'll always write a lot of content It'll be available through the Curator platform, just to make sure you're always in contact and understanding your thoughts and approach you take.
Awesome. Thank you. Thanks, everyone. And thank you to guys. And thanks for coming all the way down from US and the UK.